All right, guys, let's quickly take a look at that Swiss inflation data coming up in about an hour and a half's time from now. Now, this data has the potential to be traded in both ways. This data will probably not change my medium-term outlook for the Swiss franc, which I do think is bearish, which I think is based on more than just the fact that the SNB is expected to cut rates. It's really based on the fact that, unlike many of the other economies out there, Switzerland is now facing a real deflationary risk. Unlike the US, the UK, Europe, Australia, New Zealand, Canada, unlike all of those countries, Switzerland is actually facing a bit of deflation risk. And this is something that we've been talking about for the last few months now. You know, if you take a look at the chart of inflation, this is unlike any of the other major central banks. You are looking at both headline and core inflation sitting around the 1% level. That is miles below their just below 2% target, right? So this is something that they need to be concerned about, because remember, something that Switzerland didn't face for a very, very long time, much like many other major economies, was inflation. But to the extent of other economies, Switzerland had it much worse, right? They were fighting a strong currency for such a long time. And we saw that if you take a look at their reserves, if you look back all the way to 2014, all the way up to 2022, what they were doing with their reserves is they were trying to prop up their foreign currency reserves and shorting the Swiss franc, basically trying to keep it weak to try and just generate some inflation and obviously help their economy as well. All of that was was turned upside down when we went into that massive inflationary cycle, where for the first time in a very, very, very long time, they actually did the opposite. They were actually selling off their foreign currency reserves and propping up the Swiss franc to try and curb inflation. So unlike many of the other central banks out there, they actually used currency strength as the main driver for pushing inflation lower. And, kudos to them, it actually worked. Inflation came down aggressively, but now they are at that point where it's come down so aggressively that they have now started to move in the opposite direction. Take a look at that big jump that we've had to the upside in foreign reserves. This is them saying, oh boy, maybe we did this a little bit too long. Maybe we should have listened to those guys from Capital Edge a couple of months ago when they said we should stop. They wouldn't have had this problem, right? So now they are aggressively adding back foreign currency reserves, and that has obviously kept the Swiss franc weak. And that means that regardless of what happens to the inflation data today, that medium-term bias should remain tilted to the downside as long as inflation remains well below that just below 2% target. So even if we get a big pop to the upside here, like close to 1.3 or 1.4, that is going to be tradable short term, don't get me wrong, and we'll touch on why that is in a second. But it's probably not going to change the medium-term view. At this stage of how Swiss franc pairs have traded, I would actually prefer an upside surprise that sees a bit of that short positioning shaken out so that we can get back in at more attractive levels for medium-term positions. But if we don't get that and instead we get a massive miss, it's still tradable. It's still in line with that medium-term view. We just have to start worrying about stretch positioning. The one thing just to keep in mind about positioning is that if the SNB is actively pursuing a weaker currency, even though they don't say they are, but their reserves are showing us that they are, as long as they are actively pursuing a weaker currency, positioning is important, but it's not as important, right? If they are forcing it lower, then it's going to get more stretched and more stretched and more stretched and more stretched. How long is a piece of string type of thing? Remember, we never take a trade just because something is looking stretched. That is a very good way to lose money in the markets. We don't think about it from a contrarian view like that. We think about it, okay, is the markets oversubscribed short to long? Yes, they are. Cool. What type of triggers do we need to see some of that shaken out and to give us a high probability opportunity? That's really the only thing we care about, right? So having said all of that, how can we approach today's print? Now, obviously, if we see a huge downside surprise, that is the one that feeds into our medium-term view. So if we can see inflation, I would say well below that 0.9% level. So seriously cracking some serious moves below the 1% level, because keep in mind, even if we just print below where we are now, even if we just print below 1%, that'll already be a fresh cycle low. But we're looking for that shock factor. Why do we need a shock factor to the downside today? Well, take a look at positioning. Massive, massive stretch short position. So even though it shouldn't matter, right, for the SNB, if they continue pushing the currency lower, then positioning isn't going to matter. But I would still like to see a juicy, juicy, juicy miss to give the markets the confidence to say, yeah, let's press this sucker, even though it's stretched to the downside. But for that, I think we would need to see something below that 0.9, maybe 0.8 or lower. I think that should do the trick. So below 0.9, I think could be good for a short. What can we look to trade? Well, yesterday we had the FOMC coming out. And this is where we need to be careful. I'm going to say dovish, but they weren't dovish, right? They sounded dovish because of pre-positioning, but I'll get to that in a separate video. We have the dollar to the downside. What is that good for normally? Well, the euro, right? Why do we like the euro long right now, apart from a weaker dollar? We had good Eurozone data out this week. Inflation surprise to the upside, growth surprise to the upside. The currency, as we know, is also still on the stretch side. So I quite like the euro. Why not go for something like the Aussie Swiss franc? You know, that's also a pair we have medium-term buyers on. The only thing keeping me back from Aussie Swiss franc as opposed to trading Euro Swiss franc is just still commodities, guys. You know, copper had a bit of a pop to the upside, but commodities are still giving me the heebie-jeebies here. And if commodities continue to push lower, it's just not going to be that positive for the likes of the Aussie. So I would prefer trading something like the euro. I just think that's going to be a much cleaner trade to be had. So if we do see that big type of miss, what's interesting here is that, you know, for pairs like the Euro Swiss, the Aussie Swiss, we are moving into some major levels of resistance around that 98.50 psychological level. It's the high going back to the 4th of April. It's the implied volatility high. That is going to be a tough nut to crack. But if we get 0.8 or lower, I think it should be enough to give us a nice breakout trade to the upside. What can we be targeting? Firstly, we need to cover or clear that 98.50. Once we've cleared that, though, we've got the high going back to when was that? The April 2023. That should also be very close to the implied volatility second deviation level. It's right on top of that. So that gives us a nice target to aim for to the upside in the short term. I will be more short-term focused on this one, purely based on positioning. Positioning isn't going to keep me away. That's not the one. There we go. Positioning isn't going to keep me away from, trading this in the short term, but medium term, it is a little bit more risky. So we just need to keep that in mind. Now, because positioning is so stretched right now, that is the only reason why I think an upside surprise in inflation could be tradable. But once again, short term. Why? Because let's just say we print above 1.3%. That is the number that I'll be aiming for, 1.3 or higher. Why 1.3 or higher specifically? It's not just a some fuck number that we are looking at here. The prior number that we had, the prior print before the most recent one, or two before that rather, was 1.28. So that's about 1.3%. We ideally, for a good trade, we want to see this chart pushing back above those levels, giving a little bit of a possible reacceleration fear, in the markets. Doesn't mean it's going to happen, but if we see just a marginal move higher, I don't think it's going to be enough. But if we can see something like 1.3 or higher, cracking above that January high, that should get the markets thinking like, whoa, okay, that's a bit of a move to the upside. Maybe those amounts of cuts that we've got priced in, maybe that's a little bit too aggressive for the Swiss franc. And that can obviously give a good reason for these straight shorts to dump those positions and give us a good trade to the upside for the Swiss franc in the short term. What can we look to trade? I think the obvious choice will be dollar Swiss franc. Dollar weak still after last night's FOMC. The pair is looking stretched. We've got positioning looking stretched. So what's not to like? If we get 1.3 or higher, I think that could be enough for a move back down towards 91. Psychological, we've got the implied volatility just ahead of that. And if we do manage to crack below that 91, I mean, we've got a very attractive move down towards that 90.20. Do we get there? I don't know. We could, but I would be happy, to at least get out at 91, move stops to break even, and then see whether the markets have more to give us. So that's just a quick view of that inflation data. As always, any questions, don't hesitate to let me know.